The U.S. stock market has seen some of the strongest rallies in the last 75 years. We're going to talk about what's next. Is this an inflection point? Is this the end of the rally, or is there a lot more room to climb? That's the theme of our discussion. We'll be talking about all asset classes today: stocks, bonds, gold, precious metals, real estate as well. Chance Finucane joins us once more. He's the CIO of Oxbow Advisors. Welcome back to the show, Chance. Always good to see you. Welcome back.
Great to see you, David. Thanks for having me back on the show.
You warned in one of your recent video summaries of the economy, and I encourage people to check out Oxbow Advisors YouTube channel, link down below, where they give regular summaries and outlooks, presentations. We can talk about what you discussed in your last video, where you warned that the U.S. stock market is dangerously close to euphoric territory after more than a 30% surge over the last couple of months. This comes on the back of some warnings by big banks. So CEO of Goldman Sachs, David Solomon, recently said in a conference in Hong Kong a couple of days ago that he's expecting a 10 to 15% correction, which he says is normal even for bull markets. This was echoed by another banking chief. So we have here warnings by large financial institutions, leaders of large financial institutions, that this rally may see some bumps ahead. I'm wondering what your view is, and whether or not you think a pullback from here, or maybe a little bit higher from here, is reasonable.
It would be reasonable. It does not mean that it has to happen. A lot of the short-term activity is less to do with current valuations and more with just investor behavior. And one thing we do look at is just the trends in economic growth. And one thing we are looking at for the first quarter to start next year is the comparisons with the very low economic growth reported in the first quarter of 2025 is going to make the economy look like it's accelerating in the first quarter of 2026. It's difficult for stocks to really fall off if you've got accelerating economic growth. So it may not be that there's a significant correction or bear market in the next few months, but we do think that at current valuations, if you look out on a longer term horizon like we do, where we try to look out 3 to 5 years, we have lower expected returns for the market indices, given that they're trading at 23 times forward earnings and are really just being driven by the one AI theme, where nearly half of the market cap of the S&P 500 is these AI-related stocks, whether that's in tech, industrials, or utilities that are considered beneficiaries. And they've appreciated by more than 70% in the last 6 months, while all the other names, the other half of the market's only appreciated by 11%. And so when you see a move like that, we don't think it can continue forever, and we would expect a correction at some point in the intermediate term.
Let's just take a look at the performance so far. This is the year-to-date chart of the S&P 500. It's up about 16%. Now, I did state that it's up more than 30% as of May. This comes following the Liberation Day market crash. If you take a look at the sector breakdown, year-to-date, tech, to nobody's surprise, was the top performer, up 26%, followed by communication services, industrials, and utilities. These sectors all did very well, and most of those sectors outperformed the S&P. The other sectors actually underperformed the overall index. So if you're taking a look at overall performance thus far, we're talking now on the 5th of November, and of course, gold and silver has done quite well. Bitcoin is flat on the year now. Are you thinking of rotating capital at all? Are you thinking of taking profits in some sectors or assets and rotating into something else?
We have rotated some. The decisions we make are always incremental. I think that's something that maybe people don't sort of see what's happening behind the scenes, but you're not making a full flip of your portfolio at a right specific point in time. The decisions you make are incremental, 1% here, 0.5% there, and then over the course of a year, you might have a 20 or 30% different allocation within your portfolio. So you mentioned the gold and silver miners. That was an allocation that we had, especially in the high income strategy that we run, that's been an outstanding performer for us. And we trimmed a number of those big winners in the last month or so, just trying to get back to more of a normal allocation, closer to a high single digit percentage of the portfolio after it had done so well here over the last year or two.
Another highlight, a risk that you highlighted recently is the concentration of AI and tech in the S&P. I think it's climbed from 26% to 34%, you said. Now, Given how dominant this sector is now in the overall stock market index, we have to track what individual companies are doing. Just this week, Palantir, Oracle, both missed earnings estimates. Oracle, in particular, you highlighted. I'll let you talk more about this in the video. They are now expanding at a rapid pace, but you highlighted the fact that they now need to expand using debt financing, and you likened this to past speculative mania, similar to the railroads in the 1800s, Japan in the 1980s, the dot-com bubble, and so on and so forth. Tell us about this cycle and how it's different from the past or similar.
Yeah, I'd say what's different is that these large businesses that are pushing so much into the AI boom have solid businesses to begin with, and they have a lot of free cash flow that they were able to pull from to start doing more capital expenditures to try and finance the build out for AI. But what's happened in the last year is they're now spending so much on CapEx that these companies have to start issuing debt. And that's where you now become reliant on external investors to finance the build out. And right now, investors on the outside are very keen to want to invest in the debt. But this only works for as long as those external investors are happy to keep doing this. And there are examples that we and others have cited, like you mentioned, the dot-com bubble or the railroads more than a century ago. But just thinking of a more recent example, where you got to pay attention to what investors are really trying to incentivize company management to do. In 2021, when rates were still at zero, the thing that investors were most interested in was revenue growth and what was the biggest addressable market. So you had all sorts of companies talking about these huge opportunities in e-commerce or other areas that they were pushing towards. And even if they had no cash flows, no profits, nobody cared. And those share prices were pushed up to record levels. In 2022, once interest rates started to move higher and you had an actual comparison for a base rate of return, then investors changed their mind. They weren't caring about revenue growth anymore. They wanted to see profits and free cash flow. And those company management teams adjusted really quick, but what changed is they stopped spending so much. So taking that back to today, right now, if there's an announcement about a deal made and there's going to be hundreds of billions of dollars spent in CapEx, that's being rewarded. But at some point, it will not be rewarded by external investors anymore, and you're going to see a shift in behavior by company management to try and preserve the gains that they've had. And that's what we're really waiting for, is what's going to be the fallout when that inevitably occurs.
This slide summarizes what you've just said, and it actually echoes the viewpoints of a lot of other investors right now. Circular AI deals look like dot-com bubble, and I'll let you explain what this chart means. Chance.
Yeah, sure. So NVIDIA is the easiest example. So it's a great business. They have fantastic profit margins. But to finance this AI build out, what they're doing is they're making agreements where they'll make an investment in a company that does not have the cash flow to buy NVIDIA chips to build out their own data centers. So NVIDIA makes an investment, and now that company has the money to turn around and buy chips from NVIDIA to build out their data centers. It's okay to do this, but it only works for as long as these external investors are helping finance the deals. And so there's no telling how long it will last. It could be over in a matter of months or a year or 2 years or 5 years, but this does not go on forever. And it's very similar to some of the vendor financing we saw at the height of the dot-com bubble with companies like Cisco, Nortel, Lucent. So that's where it's giving us a little bit of a reminder. And as I pointed out in the video, we own a couple of companies on a chart like this, like Microsoft and Alphabet, that we've owned for a decade or longer. We're monitoring them closely. The earnings quality they're reporting is very good. The price momentum of their stocks is very good. For now, that's more than offsetting the increase in capital expenditures. But you have to keep watching all of this together, because if all of a sudden all of it turns negative, that would be the time that we'd be thinking about trying to reduce those positions or getting out entirely.
I think another point we have to discuss, which may have slipped some people, is that if one company takes stakes in others, and they're all taking stakes in each other, or not even taking stakes, equity positions, but just investing in CapEx, in infrastructure, or buying equipment, or buying IP, for example, then basically the valuations of other companies will directly affect the valuations of one company and vice versa. So basically, if let's say Microsoft's results don't deliver, or if let's say their infrastructure doesn't exceed expectations, it could potentially pull down the valuations of any other company that has made stakes in Microsoft or Microsoft's projects, and vice versa. So we're basically seeing not just the emergence of not just an entire sector, but one mega company, if you want to think about it that way. Chance.
Sure. My favorite example of this is NVIDIA. One of their biggest rivals for over a decade has been AMD, Advanced Micro Devices, and NVIDIA invested in OpenAI. OpenAI took some of that money, turned around and invested in AMD. So NVIDIA now is a significant shareholder of AMD, one of its chief rivals. So to your point about it all being interrelated, it's definitely drifted that way.
So then what happens if, let's say, one company misses earnings or starts underperforming? One of two things could happen. One, it could pull the entire sector down, or two, actually, their negative earnings could be offset by more positive growth from their competitors, which is kind of a clever strategy when you think about it.
It's possible. You could try to pick out which one you think is going to be the winner. What's interesting is watching interviews with really top specialist investors in this sector. Everyone has a different opinion about, would you rather own Google or Meta? Or would you rather own Microsoft or Amazon? Nobody has a clear picture of who has the real edge. So it makes it difficult to really know who's going to be the winner. You could try owning all of them, which is what everyone's been doing, and it's been working out over the past couple of years. But you got to know when to get out because there will be a fallout on the other side of this cycle. When we look at it, we're just to keep it simple, we'll look at the valuations of an industry like the semiconductor stocks, which have done incredibly well. They've essentially doubled in the last 6 months. And we just look at it from what do we think their fair value is today? And then if you look at the last decade, what's been a great buy spot if you look at their valuations that you could have bought at 2 to 4 different times in the last decade. And we think they're trading pretty significantly above fair value. But the downside in a typical bear market for these semiconductor stocks, not even a terrible bear market, just a garden variety 20 to 30% drop for the market, would be more than 40% drop for these semiconductor stocks. So just the way that we invest, we're very focused on the downside protection for what we choose to put in our clients' portfolios. That's just not going to be a fit for us. If these stocks all came down by 25%, we'll be taking a look at them again and see, if there's a few that we might want to put in small positions and start looking at more closely. But with all of the optimism that's pushed into the valuations today, we just don't think it's worth it.
Now, another slide I want to bring to the viewer's attention is allocation, which ultimately is the most important part of any discussion with a fund manager. We do not recommend 7 to 8% stock weights. Why not?
We just think for most people, especially for our clients who are more high net worth individuals, many of them own their own businesses. They're in the second half of their lives, and they're really just trying to protect the purchasing power of the wealth they've already accumulated. You don't need to be taking big concentrated positions. So there are plenty of great investors in history that have had very concentrated portfolios and done tremendously well. But we think for most people, having a more diversified portfolio, more balanced across individual positions and sectors and asset classes is going to do better for you in the long run. And if you look at this chart, there are a couple different areas that we thought that the market was a little bit healthier on this diversification point. So if you look from 1990 to 1995, the biggest position wasn't more than 3% of the S&P 500. The 3 largest positions combined were less than 10% of the overall index. And then same thing again from 2010 till about 2016, which Apple was the biggest company, but it wasn't more than 3% of the index. And then the 3 largest positions, same thing, less than 10% of the overall portfolio if you just own the index. We think that's a healthier backdrop, and that was a great time to own stocks at reasonable valuations. Today, you buy in, you've got 3, 7 to 8% positions, and you pointed out how interrelated these stocks are. It's a pretty big implicit bet that you're making that this is all going to work out well in the longer term. We would just rather be spread out more in a very intelligent, intentional fashion across more industries and sectors.
Given that the Fed is in an easing cycle and given that quantitative tightening is expected to end in December, which we can discuss, wouldn't you be more risk on overall in your allocation and your attitude? And this comes after the fact that people have pointed out that the Fed is now cutting into a market where the stock market is at all-time highs. When they've done this historically in the past, there have been a few examples when they've cut rates at all-time highs. The market has continued to climb much higher a year later. Maybe there's been fluctuations during that year, but it's always been much higher into that bull market following a Fed cut. Is this time any different?
Hey, you could be right that for the next 6 to 12 months, and we do agree that it seems like the Fed, they're ending quantitative tightening on December 1st. It would not surprise us if the next Fed chairman that's appointed in the spring of 2026 is more dovish and cuts short-term interest rates further than people might anticipate. But we're looking at this further out, looking out 3 to 5 years and saying that when we look at the things that you're mentioning there, we're thinking this means that inflation is going to be higher for longer. It's going to be difficult to get it back down to that 2% target that the Fed has. And so we're trying to make sure that portfolios are positioned for businesses with pricing power and for businesses, especially in our high income strategy, that have more exposure to commodities, because we think that's an area that's continued to be underlooked and under-owned. And it's served us well to have a significant allocation there. And we plan to continue to do so probably for the rest of the 2020s.
It certainly looks like if you just take a look at the last couple of Fed easing cycles, they've cut during periods of either financial distress or after a major collapse in capital markets. So 2019, they've already started cutting rates before COVID. So that actually didn't count, but they exacerbated or they escalated the pace of the rate cuts following a global pandemic, which was a disaster for all markets. 2007, 2008, again, they started cutting before the Lehman collapse, but same thing happened. They accelerated the pace of quantitative easing and easing monetary policy after a major financial crisis. Same thing happened in 2000. And now, it's interesting because the only historical precedents that we have for the last 3 easing cycles are major collapses in the stock market. That's not what's happening here, right? That's the Fed isn't reacting to the capital markets falling, as was the case in 2020, 2008, and 2000. This was, this is obviously very different. Chats, can you just maybe explain as an investor, you're looking at this pattern and it's broken. So
Sure.
What does this mean?
Well, we would actually go further back, and our managing partner, Ted Oakley, likes to mention Arthur Burns in the 1970s when they were trying to cut rates before they really got inflation contained. And then what ends up happening is the inflation rate accelerates higher again, and you have to raise rates to try to counteract that, which then hurts the economy, hurts financial asset prices. And that's the sort of thing that we're watching out for. And we went through that in 2022 when they kept rates low for too long, and then they had to raise rates faster than people anticipated and they would have wanted to. And you saw asset classes across the board underperform. That's the sort of thing that we're trying to monitor for, is more of a cycle like that, rather than, what you're citing, that was the middle of a period, the final 20 years of a 40-year disinflation cycle. But since 2020, we think we're actually starting into more of a long-term inflationary cycle where it's just going to be harder to keep inflation down. And unless they really want to see it through to get the inflation rate back to a 2% rate or lower, every time they cut rates like this, is going to allow the inflation rate to drift higher, and they're going to be stuck in a difficult position to have to try to either let the inflationary bubble run or try to raise rates, which is going to hurt asset prices.
That's a very good point you brought up, Chance. This is the first time in basically 3 decades where they've cut rates, or 2.5 decades rather, where they've cut rates during a time that is not a deflationary event. It's not the pandemic. It's not the financial crisis of '08. And it's not a dot-com bubble that wiped out 99% of tech stocks. This is a time when inflation is actually running hotter. The economy is still grinding along. and there is no capital markets collapse. So what do you think is going to happen to inflation then?
We would expect if they keep cutting rates, and if they put in a Fed chairman next year that significantly cuts rates further, that very likely is going to push inflation higher. And we would expect it to stay at around 3% inflation rate for the remainder of this year. But it risks the inflation rate drifting higher again and putting them in a difficult position that they have to decide what they want to prioritize. Right now, they say they're prioritizing employment and they're not so worried about inflation. But we'll see what happens, especially just other things moving around the world, where a lot of the tailwinds to a disinflationary environment that we had from 2000 to 2020 are not really there anymore. And so we'll see how things play out. But if they keep cutting rates, it's going to make it difficult to keep that inflation rate low.
But it's not a certainty that even the next Fed chair, who most likely be more amenable to Trump's wishes for a lower rate, the next Fed chair is not going to dramatically cut rates if inflation runs significantly hotter than 3%, right? That would just be nonsensical. I mean, political pressures aside. What do you think?
You would think so, yes. We would agree with that, but we also didn't expect them to start cutting rates when the inflation rate was still at 3%. So
fair enough.
To the point, it kind of goes back to the idea about market concentration. The inflation rate target is just a feature. Like if they want to target a 3% inflation rate, we might disagree with that, but they're saying that the target is 2% and they're cutting, before we're even close to getting there. So we're just trying to monitor what we think they're doing and then what are the ramifications for that. And so when we look at that, we didn't touch on this, but like a high budget deficit that's not going away, plus inflation running higher, we don't want to own long-term treasury bonds in that sort of an environment. We're going to stay shorter-term treasuries. We're going to have a higher allocation to commodities. We're going to try to stay very high-quality, reasonably priced stocks that we think can kind of control their own destiny, regardless of what's happening in the economy. We think that's the right allocation to have, rather than trying to chase a trend at high valuations or try to go against the inflationary trend with bond proxies that might struggle a bit if inflation rate stays high.
You actually brought this up in one of your slides. U.S. debt is risky for long-term bonds. Can you just explain how that works? Why rising debt actually is risky for the long end of the curve?
Well, we're worried about the debt levels in the U.S., the debt to GDP ratio, the high budget deficit, because you need external investors to want to own the long-term U.S. Treasury bond at a reasonable yield. And if external investors start to be concerned about the fiscal trajectory for the United States, they may demand a higher yield for the 10 or 20 or 30-year Treasury bond, which would put the United States in a tough spot. So part of this is thinking that inflation could remain higher for longer. The other part is we think more attention is going to be paid on the part of investors to this deteriorating fiscal situation. And just to put it in perspective, you can go back through decades of history, and the income for the United States from collecting taxes from businesses or individuals, things of that nature, it's about 18% of GDP. And we usually run like a small, low single-digit budget deficit, just based on the way that our economy is made up. Right now, though, we're spending 23% of GDP on fiscal spending, which is almost like the equivalent of being in the middle of a recession. It's not what would be considered sort of a peacetime growing economy if you look back at our history. So that puts us in a tough position, because if we actually do have a recession, that budget deficit is going to widen. It's going to make our long-term Treasury bonds less attractive, and that risks the yields going even higher. So when we look at that sort of a thing, you might have shorter or lower long-term Treasury yields in the near term, but when you look out several years, it makes it difficult to say that's a great place to be.
Yields have been grinding higher since 2020, and they've stabilized somewhat this year. And they've fallen a little bit since 2024. If you zoom out, Chance, people have pointed out that there is a multi-decade secular, there has been a multi-decade secular decline in long-dated bond yields, and that trend has reversed in the middle of 2020. Do you think that this reversal is the beginning of a return to high single-digit, if not even double-digit, 10-year bond yields, which is what we got in the 80s, and obviously that implies higher inflation as well, or is this really just a shorter term trend where we have the end of zero interest rate, end of ZERP? The Fed ended their zero interest rate environment, and we're just going to stabilize around here. What's your view here on the future of the 10-year yield?
Yeah, well, and you had it when you expanded it out. That was a 40-year bond bear market from 1940 to 1980 or 81, and then we had a more or less 40-year bond bull market where yields were falling. And we would agree that we're 5 years into a new multi-decade cycle. We do not know, we're not trying to predict how high this goes, if it goes to a 10% yield or higher. We're just acknowledging that the tailwinds you had with consistently lower inflation and falling interest rates, that was such a benefit to investors with balanced portfolios. The idea of the 60-40 portfolio, that 40% in bonds was just working for you the whole way over the last 40 years through 2020. We think that becomes significantly more difficult to achieve, and would expect that interest rates moving higher will act as a headwind to some of those sort of bond proxy type asset classes. And so from our perspective, we've adjusted, especially our high income strategy, which I was telling some people here back in 2019, we had 10% allocations to long-term treasury bonds, 10% to preferred stocks, 10% to REITs. And that's very different now. We're way more focused on short-term treasuries, commodity-based businesses, very little allocated to REITs and preferred stocks, zero allocated to long-term treasury bonds. And that's an acknowledgement of what we think the start of this multi-decade trend could look like.
Another slide I want to bring up is the amount of leverage in our system. So this is something that may be concerning for some people. So market speculation is reaching new highs is the title of this slide. Number of leveraged ETFs at record highs. What does this signify? Could this mean that we're going to have more volatility in the future if, let's say, the market moves in either direction? More leverage means, basically more movement on the periphery.
Yeah, I think there is more movement. When we look at this, so the leveraged ETFs, that would be like ETFs that are issued that will give you 2 times the return on Tesla, or 2 times shorting Tesla, or 3 times. And then the amazing one is a company came out with 5 times levered returns on an underlying stock or industry. And the risk of this, unless you're like a very short-term day trader, you really don't want to be dealing with these. And the best example I saw was AMD, the semiconductor company, had an earnings release or an announcement that was very positive. The stock was up more than 30% in a day, and there was a 3 times short AMD ETF that went to zero overnight because all of a sudden it was up more than 30%. Multiply it by 3, you lost all your money if you were in that. And that's the risk that people are taking if they're trying to speculate in these levered ETFs. We just wouldn't recommend it, and we think it's sort of a sign of the rise of the retail trader, which there are plenty of great retail investors out there. But I think there are a lot of people that might be speculating when they don't need to, or getting caught up, that we would just say, try to keep that desire for risk more reined in and just try to keep things more balanced.
Just to be clear, this chart shows the number of leveraged ETFs issued and offered on the market, not the volume of ETFs or the volume of total market cap of ETFs held, right? It's just a number of products available.
It's just the number of products available. But to put some numbers behind the volume side, Mike Green, I'd seen an interview he did where he was studying, he's writing a book on the financial markets that should come out soon. And he was pulling some data that showed that if you look back 30 years to the mid-1990s, almost 80% of the trading volume was coming from active fundamental investors. That's now down to more like 10%. In the meantime, the retail investor, with the rise of Robinhood and free trading in regular stocks or options, has gone from single-digit percentage of all volume now 20% of the volume. So retail traders are now double the volume of sort of the active money managers that are trying to think long-term investments. So it just tells you the increase in noise in the system. And we really don't even pay too much attention to some of the meme stocks or things that are moving so much up and down. We're just trying to focus on what we think is the best fit for our clients and what's going to serve them well with the wealth they've accumulated.
Well, if the fund management industry is correct in speculating that more retail investors are going to dominate the market, which is ultimately why they're offering these products for retail investors, what does that mean for the market overall? If a higher percentage of stocks and equities are held by the retail side versus the institutional side? I believe, correct me if I'm wrong, but 40 years ago, almost none of the market was held by retail investors. Is that correct?
Yeah, that's correct. It was just expenses were high, access to information was way more difficult, and that's actually a nice thing to have. There's a wealth of information, a lot of it freely available, and there are plenty of people out there who just have a really good sense of how to invest, and it's nice that it's available for them to do that individually. But there's also plenty of people that might be speculating that we would say you're best off speaking or finding a financial advisor to just assist you with these decisions over the course of a lifetime. To your point about what this means for the market, retail traders, from what we've seen in the data, tend to push the momentum factor. They're going to play what's been working. And what that means is bigger swings up, like what we've seen since April, but then also bigger swings down because they're going to want to get out all at the same time. As soon as something, a news piece like Liberation Day in early April, something happens that people aren't predicting and everyone turns bearish, that means things can go down very quickly in a way that we hadn't experienced until really the last 5 years, starting with the COVID drop in 2020, which was a huge external event. 2022 is a little bit longer of a more of a 9-month bear market. But then what we experienced this year, that all happened over the course of about a month, that you had a 20% drop, 30% in some of the more volatile names. And so that's the thing that you just need to be prepared for. For us, we're just trying to focus on things that are reasonably valued, and then we're ready to act when that noise and that movement provides really good things on sale, even if it's just for a short time, and we can take action.
Have you and your colleagues looked at the real estate sector? So I've pulled up here XHB, which is the State Street Home Builders ETF. Now, most of this year saw the ETF correlated with the S&P. Now, you can take other home builders ETFs and home building construction ETFs, and they all have similar patterns here over the course of the year. They started to diverge from the S&P around mid-September. And that's kind of interesting because that's when we had the Fed pivot. You would think that a lower interest rate would incentivize home building activity, but that the exact opposite seems to be happening, at least what's reflected in the valuations. I'm not sure if that's actually a reflection of home building activity in the real economy, but I'll let you comment on this.
Yeah, the whole space, the home builders, the construction materials companies, they've been trading down in the last few months, like you mentioned. We look at those, they have very wide trading ranges. They're either working really well, and then when people want to get out, they really underperform. So for us, even though they've pulled back some, we think there's room for them to fall a lot further before we would become interested in some of those businesses. We think it's still just kind of a stagnant home market right now, where even though you've had a little bit of a drop in the mortgage rate and things like that, it's still not like it's been enough to make a lot of homeowners want to move, or a lot of potential buyers really want to actively seek out something they could buy. So we think even though you've had a little bit of a dip, you've had a little bit of a drop in the Fed funds rate, you're a long way away from the rates that people were achieving in 2020 and 2021.
So if you had to speculate, you think that 2026 is still going to be a buyer's market, given that we're not going to have a lot more demand, even if rates come down a little bit?
For the home market?
Yeah.
I think you'll be able to negotiate a deal. It's interesting, though, to see that prices are still remaining pretty high because you don't have a whole lot of new inventory coming on the market. So these home builders, they're making a lot of deals, trying to do mortgage rate buy downs, things like that to get deals done. And just speaking anecdotally, I know plenty of people that's been their route, is buying a new build from a major home builder that's willing to make those sorts of negotiations. But the existing home market, you still have a lot of homeowners either trying to sell or thinking about selling that don't want to take much of a price cut from where they think their home was worth a couple of years ago. And we'll see if or when that starts to break down further.
And finally, I want to touch on the gold market. Precious metals gold and silver, but we can focus on gold for now. I know that your firm has liked gold for quite some time, and that has paid off very well. But now we're kind of seeing a bit of a reprieve in this rally, and people are speculating whether or not this is the end. And this looks an awful lot like what happened every single other time that gold has rallied parabolically. 2011, hovered around for a while, then collapsed. 1980, hovered around for a while, then collapsed. It's basically a spitting mirror image of what happened before. Again, this time could be different for a lot of fundamental macro reasons. We have a lot more central bank demand. We have a lot more debt, as you know, and it just seems like the mining space hasn't really fired off all cylinders when it comes to M&A activity just yet, which is unlike what happened in 2011 around the same time in the cycle. So there are some differences between now and the past, but I'll let you talk about it. What do you think?
Sure. We've fortunately been very bullish on gold and silver for the last couple of years. In the near term, we got a little bit more of a neutral outlook. As I mentioned earlier, we trimmed some of our largest winners of the mining stocks that we owned. And it would not surprise us if there's a pullback here in the gold and silver price over the course of a couple of quarters. And with the way that gold moves, just for instance, you got above $4,000. If it fell even all the way back to $3,000 an ounce, that wouldn't shock us. But this is a long-term holding for us. We plan on continuing to maintain an allocation to precious metals, I would imagine, through the rest of this decade. And I had included a chart in my presentation just talking about the central bank, their share of reserves of all central banks in the world that were in gold. And if you look back at 1980 at the peak, it was something like 60% of their reserves were in gold. And then over the course of 20 or 30 years, they reduced those holdings down to only being about 10% of the reserves. And what changed was a few years ago when the United States and others really went after the U.S. debt holdings in Russia, that made a lot of countries start to think that they need to diversify their reserves. And there's been steady structural buying from countries around the world of gold. Until you start seeing that trend change, we think that structural buying from large, considerable institutional type investors is going to be a thing that helps the gold price stay in this sort of range that they've gotten into, and then potentially even continue higher in the years to come. So wouldn't surprise us in the near term if it shows some weakness, but we still maintain nearly a 10% allocation to gold and silver or businesses in that world in our high income strategy. And we own a few royalty businesses in our stock portfolio for clients. And I would expect we continue to hold that sort of allocation for the foreseeable future.
You mentioned you took some profits off the table for the miners. At what point, this is the GDX chart, at what point in this rally did it look a little frothy to you? And at what point did that, did this chart trigger that kind of a decision?
It was in the last couple of months that we ended up doing that. I think when it got to 4,000 in the gold price, that was where didn't expect it to get there that fast, and then thought that could have been it, just because that's sort of a mental trigger for people, a big round number. And then went even higher towards 4,400. But we really try not to play with price targets on something like this. It's more about the direction and who are the long-term buyers or sellers in an asset class like this. And we just think there's been a shift in behavior from some major players in these global central banks, and we would expect that to continue. And then if you flip that and think about the fiscal activity, like the United States and what they're trying to do with their, trying to deal with the budget deficit, increasing debt loads, we think that could lead to weakness in major currencies around the world, which is a good thing for gold.
And finally, on the miners themselves, how do you assess whether or not a miner has a future, especially in an environment like $4,000 gold, when it seems like everyone's printing money, but these companies have to still stay disciplined what they're spending. So what do you walk us through your decisions when picking miners in one of the best rallies in bull markets in gold history?
Yeah, I'd say the biggest thing, you'll know if there's a management team that's just making decisions, major allocation decisions that you just think are not prudent for the future of that business. But the biggest thing is the jurisdictions that miner has their mines. So a company we've owned for a while, Agnico Eagle Mines, AEM is the ticker. They've got jurisdictions in areas that we think are safe places to be, good regulatory framework by those governments. And so that's something that, we're more happy to own that there rather than some other miners that might be in other jurisdictions that it's more unknown if any governments where they have mines might say, we want that mine back for ourselves. And that's the risk that you take on some of these. The other factor is, by and large, almost all the time we want to focus on miners that are more the larger miners, more established, already have existing free cash flow. And then when you get a run up in the gold or silver price like this, the margins they're reporting are really outstanding. I mean, almost as good as a tech company or even better. And then you just want them to make the right decision in terms of returning it to shareholders, not doing dumb acquisitions, things of that nature.
Final question before I let you go, Chance. What is the next major piece of news, either politically, geopolitically, or a macro event that you're watching for that would impact your portfolio allocation decisions one way or another?
Just thinking, I'll be curious to see going into next spring what they end up doing with. We've heard different reports on who the next Fed chairman will be, and there are one or two that might be more in line with Fed chairmans or that we've had in the past. And there are one or two that might really want to cut rates significantly, and that might have a significant impact on where the inflation rate goes, how the views of long-term treasury bonds look on the part of investors, and what that does to other asset classes. So that's one that I think going into next year, we'll be very curious to see how that plays out.
Oh, I appreciate it. Thank you very much, Chance, for your time today. Where can we learn more from you and Oxbow Advisors?
Yeah, if you'd like to learn more about our firm, you can check our website at oxbowadvisors.com, or David had mentioned we have our own YouTube channel if you search for Oxbow Advisors.
Yeah, please do follow Oxbow Advisors there. Links down below. And I encourage everyone to check out the YouTube channel as well. Thank you very much, Chance. We'll speak again next time. Take care for now.
Thanks, David. We like to provide the content we think is most valuable for studying the financial markets today. If you'd like to learn more, please subscribe to our Oxbow Advisors YouTube channel.